Netflix among the worst performing names in the NASDAQ 100 this week, but the stock's been an outperformer so far this year, up 34%. The company's set to report earnings on Thursday. And joining us with a preview is Laura Martin of Needham. She has a buy rating on the stock and a $700 price target. It's not too much higher from here, but it is higher. Laura, what's the upside that you expect in this earnings report next week?
So, I think we're waiting to hear, now that they've actually anniversaried their password sharing, how many subs they're going to add. So last quarter, they added 9 million subs. We're projecting 2 million and 4 million next quarter. But if there's any kind of weakness in those, that would be bad for the share price. We're also looking at where the subs are added, because recall that the U.S. ARPU, or average pricing, is 2 times higher than both Latin America and APAC at $16 a month here. So it really matters where they're adding subscribers. Otherwise, there's a threat to the revenue growth line, which we don't want to see. We don't want to see a slowdown in the revenue growth line from that 15% that they already reported in Q1 and we're projecting for Q2. All of those would hurt the stock if they don't hit those metrics or over deliver them. And then I really care about the content budget. They have told us that they are not spending more than $17 billion, but recently they announced they're doing 2 NFL games on Christmas Day. And I want to make sure that we're not seeing the content budget creep up to pay for sports, because that means it's a bad sign if they're going to be in these big wars for big NFL packages at Netflix.
Right. Yeah, you don't want them getting into a spending competition with some of those mega caps out there. I'm wondering about the impact on Netflix as mainstream consumers are feeling a pinch. We saw impact on the big banks today on some of those stocks, net interest income and things like that. But I know the prevailing wisdom is Netflix is the last subscription service that you drop. But are there churn dangers? Are there dangers of the ad tier not monetizing as well as investors might be hoping?
Yes, absolutely danger. The Parks data out last week said that the average spending on streaming has gone down from $90 a month in the first quarter of 22 to $63 a month in the first quarter of 2024, in part because all of these ad-driven tiers, people are sort of downgrading how much they spend per service. But what Netflix has told us is that people do not move from whatever tier they start at, which would imply if Netflix, because it's raised prices, is taxing you too much, people just disconnect. They actually don't move down to the ad tier, which is counterintuitive, but that is what Netflix tells us.
Do we need to think about hits here? I mean, the movie theaters are having a strong summer with some of the names, but we're waiting for Stranger Things from Netflix. If people are churning off more often, are they going to churn back on, if I can even say that, sign on for these big hits? And is that going to have some stock impact, you think?
Absolutely, yes, because what we see in the under 30-year-old is that they churn through these services. They go to a service, they pay for a month. It is silly that Netflix drops these popular series all in the same day. So, 20-something can watch the entire season on 1 week. But anyway, be that as it may, they then leave and they go to HBO or whoever's content is super cool. So they're churning 4 or 5 times a year. So I do expect, if you get hits, for people to come to the service and watch the hits and hopefully forget they've subscribed. But younger people won't forget that and they'll churn out. It would be much better if they did what every other service does, which is sort of launch an episode every week for 2 or 3 months. And so they would get 3 months worth of lower churn because people would want to stay till the end of the series.
Now, even though you got a buy on this, it sounds to me like you might be expecting more volatility in the stock. There's certainly lots more question marks, whether we're talking about how much they're spending on football or when they're releasing things or when they're saying that they're dropping things. How should investors think about entry points and when they get in here?
Well, I think this quarter we're about to hear on Thursday next week is sort of mission critical, because we're going to get a same store subscriber growth number after password sharing has sort of anniversaried in America. So that's super important. So if it turns out instead of my 2 million ads, they do 3 million ads or 4 million ads, all of the models are going to go up, because we're going to say, okay, that's normalized. And we were 1 million subs too low. So we'll take all of our subscriber estimates up. And then we just need to look at where they are happening. Are they happening in the $16 a month ARPU world, which is the US, or are they happening in an $8 ARPU world in Latin America or APAC? Or it's, I think, $10 or $12 in the EU. So I think our models are sort of waiting to see. We're viewing this quarter that's about to come next week as a normalized quarter. And from that, we're going to change our discounted cash flows for like the next 3 years. So I expect volatility around this quarter, either the upside or the downside.